when you own a stock, what does that mean you own? Well, it means you own a number of stocks or equities, right? And what does that really mean? Well, it means you own equity ownership. And like, well, what does that mean? Well, that means that if it goes bankrupt, you lose out, right? However, you capture the upside. If your entire investment portfolio, your net worth is like large cap US stocks, like buckle the freak up.
Buckle up.
Because there's going to be some really uncomfortable times ahead.
Yeah.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks Podcast. I'm joined again today by my colleague Carissa Bertrand here, and we are diving into one of the topics we talked about recently, which is the asset classes people should be considering in having in their portfolio to help them through a secular period of debasement. Now, I want to highlight, this doesn't mean every single day there's just, debasement. It's a broader trend, right? It's a longer term thing, and there's cycles, sub cycles within bigger cycles. So that creates the opportunity set that there's not something that just works perfectly all the time, every day, every week, every month, every quarter, every year, right? And so that's why we are going to dive into these different asset classes and talk about the pros and cons of both and why they start to add some diversification benefit to portfolios. For anyone that doesn't remember, the 5 asset classes is precious metals, Bitcoin, real estate, liquid alternatives, and what we're talking about today is large cap US stocks.
Yep.
Right. Large cap US equities. So give us a breakdown really quick, Carissa. What is a large cap US equity?
Yeah. So for those that are listening that don't know, I'm sure you've heard it, but maybe you don't quite understand exactly what that is. We're going to break it down just a little bit. So large cap, when we start with that, large cap is referring to market capitalization. That's what it's standing for. So it is a huge company that is usually at least worth $10 billion or more to qualify for that large cap title. And that is all of the value of the company's shares in total, right? That's where we're getting that number from.
The number of shares available or outstanding times the price per share.
Yep.
Gives you the market cap. The traditional view is the 10, kind of that 10 billion mark, but I would actually almost modify that and say probably looking bigger than that nowadays.
Yeah.
If you look at some of the bigger companies, there's companies that are over the $1 trillion mark now, so not only into the hundreds of billions, but now getting into the trillions. And so, if you have a company that's a $1 trillion company and a company that's a $10 billion company, the 10 billion is really, really small actually in comparison. So large now encompasses such a broad base, and sometimes people segment it out by saying, well, mega caps, they'll say mega caps. I tend to just say, you just bring up the floor a little bit on the lower end, and that probably gets you most of what you're trying to look for, right? Below large cap, you have mid cap and then small cap, and go Google those however you please if you're interested in the topic.
Yep. Good call out on that, because it seems like it's continually increasing, like that floor almost as
if there's a debasement in the currency that pushes the share prices up perpetually across the entire market landscape. So let's talk really quick. There's so much misconception, right, out there. I hear sometimes in our community, right, there can be this general sense of distrust for financial markets, or those are just shares on the, that's paper shares. That's, or whatever. And that can go away. Yeah. And people label me bearish real estate or bullish real estate, or I'm a real estate guy, or I hate real estate. And at the end of the day, I just like everything in context, But in the real estate crowd, usually one of the things that they like is well, I can go touch it. Like I look at it, I know what I have, right?
Mm-hmm.
And when you say like, well, I own a bunch of shares of a S&P 500 index fund, there's less tangible nature to this. And so it feels like, well, yeah, it's just shares, right? Like,
Yeah.
Yeah, in the same sense that you're like, well, probably in a better sense, but it feels like kind of, you can have paper cash, right?
Mm-hmm.
And that's like $100 you can touch. And, that's somewhat scratches the itch of like having $100 worth of a gold coin.
Mm-hmm.
But when you go like it's just purely digital, it's kind of like, hey, well, there's a bunch of zeros and ones in, Chase Bank's system that says I have this much dollars in my checking account. But what does that really sort of mean? And, can that go away? And how does that really work? And there's this misconception about it. But what's unique about owning like shares is there is a real asset backing this, right?
Yeah.
And I don't want to spend our limited time today talking about how to run valuation, looking at the balance sheet of companies. I think it's not an irrelevant metric by any means, but the nuances of the accounting system around it are not what people are here for. But I describe it like this, right? So when you own a stock, there's this disconnect. Like I own a share of a mutual fund or an ETF or, whatever. Okay, well, like take it a bit deeper. Like, what does that mean you own? Well, that means you own a number of stocks or equities, right? And what does that really mean? Well, it means you own equity ownership. And like, well, what does that mean? Well, that means that if it goes bankrupt, you lose out, right? However, you capture the upside. And so as this company that you're an owner of now, and that's what it is. You're an owner of it.
Yep.
Just the same as if you're a small business owner and you own a landscape company, you own it. You own a share of Walmart or Costco or Facebook or whatever, right?
Yep.
And so just in any other business, right? Like there's a customer, the customer provides revenue to the business. There's a cost of goods sold that provides gross profit. From gross profit, they pay employees, they pay expenses, they do all the stuff that it takes to run and operate a business. And then the net is the net profit. And when you own, just as when you're a business owner and you get to participate in that net profit, when you own equity ownership through stocks in a publicly traded company, you have a legal right to the claim on the net profits.
Yep.
Right. And
when you have that ownership, you also get that right that comes with it to some of the profit.
And you're right. And it's a legal right of actual true ownership. So if you own S&P 500 index fund, right?
Yeah.
You have to remember, like, go down to Walmart. Okay. Walmart trades it's in the S&P 500. And I'm just using that as an example. I'm not recommending that per se for anyone, but as an example, like you go down to Walmart and like touch that wall, grab the floors, like you own part of that, grab the employee and be like, hey, you work for me. It's true. It's
I'm
like
your boss.
Yeah. That is the truth of it though.
Yeah.
That is now that might be such a small, tiny fraction piece in the grand scheme of things, but it is real. Right. Yeah. And so when we talk about debasement, it's like, well, why own stocks? Isn't that risky to own a business? Well, like it's not any more risky. In fact, it's incredibly, from an empirical sense, a lot less risky than owning your own small business. Right.
Yeah.
Your own small business is considerably more risky. Now, sometimes we perceive it not to be because you feel like you have different levers of control.
Correct.
But if you think about the diversification I get and the limit of liability, right? If somebody slips and falls in a Walmart, they don't get to sue me as a shareholder, right? They have no way to get at me that way for my own personal net worth.
Assets.
Yeah, they can sue Walmart and, that sucks for me as a shareholder because it comes out of my value in the ownership of Walmart.
Those dividends. And
right. It dips into that. And so I still don't want that, but it nonetheless, right? But it comes back to, so why own it, right? Why own stocks? Why not own, bonds, right? Why don't I want to own a bunch of bonds or something? And at the end of the day, what it comes down to is when you own bonds, which have their place in tend to say if you need that, that's really a financial planning decision around your current, your circumstances on the horizon or the near term. But you have a contract to get paid a specific amount of dollars, right? Walmart doesn't have a contract to sell all of their inventory at a certain number,
right?
Right, and they don't have a contract that they have to pay people a certain amount. I mean, like generally speaking, right? And so what they get to do is, truthfully, like as inflation happens, and we've seen this, right? So like as much as we complain about it when we go to shop at Walmart or Costco and say, oh my gosh, groceries are so expensive. Well, you've got unanchored inflation expectations out there, which means they've been able to raise prices consistently throughout this whole cycle and charge more. And so what it means is it trickles down to their net profit, and their net profit is growing with the inflation, right? So Walmart in an inflationary environment, or Costco, or in mass, right? And now things ebb and flow, right? Different businesses are able to raise prices incrementally at different times, so it's not like some perfect linear relationship, like nothing is. But if you zoom out, generally like businesses are able to raise prices with inflation and protect their amount of gross profit. And so the profit flowing down gets bigger. Now, if we live in a secular debasement cycle, the marginal value of those dollars that come through dividends and net profit and, share buybacks are diminished relative to the inflation in the system. But nonetheless, like it's going to do a better job over time than somebody giving you a specific dollar amount.
Yeah.
In the short term, and we'll cover this in a different episode, you may want a specific dollar amount. But in the long term, you want that equity ownership that, again, just adjusts up with everything. So I think like a good example of this almost is like, people love real estate. And this is always such an interesting thing to tie back for me. Like, who owns a lot of real estate that is just some of the most prime real estate in the entire country? It's like McDonald's.
Yeah.
They're everywhere. They're on the busiest streets, the busiest corners all over the US. And all those McDonald's, not the franchisees, right? But McDonald's corporate owns that land generally that the McDonald's are on. So the franchisees lease that land from McDonald's. That's kind of their business model. Well, like if you own a share of McDonald's, you own a share of the land. It's real and tangible. And so if your argument is, well, real estate can go up with inflation, well, then so can the share price of McDonald's because it owns the real estate.
Yeah.
It's just now you're attaching some, economic business activity to it. And if you think about the way that this all works, it's really not any more complicated than real estate.
Right.
Think about real estate as a stock. Okay. You have equity ownership in this stock. Now, in this real estate activity, you may take a loan and have a mortgage, right? So there's operating leverage potentially on a balance sheet. And your rental property has expenses, right? Just like there might be a property manager. There's you got to fix things, right? You got to deal with maintenance costs. There's insurance costs, right? You got to pay to file tax. You got some additional tax filing costs. There's some tax benefits. And there's a customer, right? Which is your tenant. And so the tenant provides revenue every single month. That flows through, and all the expenses get paid. And then at the end, so you say, well, my rents are, I charge a tenant $3,000 a month in rent, and, my mortgage and all my expenses come out to, $2,500. And so I make $500 a month by owning this rental property. The fundamental like nature of it is no different in a stock.
Yeah.
It's just, instead of paying rent, they're buying a bottle of shampoo at Costco.
Yeah.
It's just the economic transaction is different, but like that's why consumer staple stocks tend to be viewed as like defensive stocks, for example, because the same argument, well, look, people are always going to have to live somewhere and pay rent. Well, they're always going to have to buy shampoo and groceries,
basic necessities.
Yeah, basic necessities, right? And so kind of where it doesn't, it's less impacted by economic cycles the same way that you would say, well, hey, affordable housing is not as impacted by economic cycles, right?
Yeah.
Okay, like there's some valid argument there. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. Let's talk about this really quick though. So I've talked a lot about a couple different companies and just talking about their business model specifically. Why don't we just go and like buy the best companies then, Carissa?
Well, you're going to lack the diversification then if you are just buying single stock companies, because you're putting, a lot more of your risk right into those companies and how they're doing specifically, when you can spread out that load and that risk across multiple companies. But
like Howard Marks says, diversification is the one free lunch you can get in finance, right? And the truth of it is like, if you're in an inflationary environment, which I talk about a lot, and just there's different environments and different cycles. But for example, like Walmart might not be able to raise its price as fast as Costco. Yeah. But Costco might be facing a unionization issue, that maybe their wage cost is rising with it really quick, and so everything kind of bobs and weaves, and having a broader selection is generally an easier play. And when I think about owning large cap US companies, I'm not trying to take outsized bets on, a certain company has a really great CEO, or, they're going to be able to do this marginal thing and maybe I'm right and maybe I'm wrong. There's a lot of data out there that shows that picking stocks specific, saying, well, I built a portfolio of 20 or 50 stocks or whatever. That is a really, really, really tough game. Really Absolutely. Exceedingly difficult game to win. And not impossible. And there's people that do it and there's people that do it really well. But it's tough to do. And it's also tough to access in like a fund where it's really publicly available, because the larger you get, the more constraints your funds end up working with, right? Like you can't just go sell, $1 billion in a day of a company, if you're a ginormous fund. And so the quick and easy way to do it is just like grab the diversification, grab some type of reasonable fund off the shelf, and, hey, work with your own financial advisor, whoever that is, and pick a sensible option. But I tend to say like the important part here is large US companies, and to explain why is I
think there's a few different reasons why you would want to get like specifically the large cap within the US. Some of that is we've already talked about a little bit, like the pricing power. They're already, and then like the resilience of them. Like these companies have kind of already proved themselves that they're pretty stable. They've been around. Like they're making pretty good business decisions overall, that they're going to be around for a while.
In a market that's functioning properly, truly properly. And what I mean by that is a market where the function of the market is for people to seek the highest and best use of capital at all times, to seek the highest return in a very rational manner. Like there should be this idea that small companies should be able to outperform, because it should be easier to grow a company from, $1 million company to a $10 million company, and a $10 million to a $1 billion company. And a $1 billion company should be easier to grow to a $10 billion company. And that should be a lot easier than going to a $100 billion company. And 10 billion to 100 billion should be probably easier than 100 billion to a trillion. And certainly that should be easier than going from a trillion to 10 trillion, right? Like
that compounding effect is huge.
It's hard to keep doubling, right? Like it's hard to keep doubling. And even Warren Buffett recognized this in his, it was like in the late 90s, he started telling everyone like, we're going to probably underperform because we're just so big. It's harder to be nimble and make get those small deals, and you can still find the small deals, but the deal isn't big enough relative to our size to be big enough anymore, right? To make it sort of, there's this drag that comes with it, right? Like you can only double so many times before you own the whole world, Yeah. And the problem is that for better or for worse, this is maybe over the heads of some people, and I can appreciate that. But index fund investing has largely broke the market structure. That capital just doesn't flow in that manner anymore. Mm-hmm. And so what realistically happens is the larger companies get access to really, really cheap capital, and they can price everyone out of the market. And they just go look at, and they look at the small guys that you would be able to buy, and they would just eventually maybe become the 10x, that 10x, and they just buy them. So, they just get bought early stage by the Googles and the Apples and the Microsofts, right? It just happens quick and early, and you never even hear about them, and it's acquired and rolled up into their big, technology up at the top, and their pricing power is so crazy. So there is periods where small cap companies can perform really well, and if you specialize in that, there is still opportunity, and I think that still is the case. And over an extended period of time, I think there's some opportunity there that can outperform. But if your goal set is to arrive to retirement on time and in a comfortable manner, you want to think long and hard about how much you really want to strategically tilt that way or not, right? And if you're not incredibly active, then you probably don't. And so that kind of is the small versus large debate is it's not impossible, but it's really hard for the big companies to go out of business, right?
Yeah. I think when you're buying those bigger companies, it's not just that you're buying the company, but you're buying the innovation, you're buying their purchasing power opportunities. You're buying all of those, the technology opportunities, things like that come with the companies that you're purchasing.
Yeah. So, if you think about these companies, I'm just going to read off the top 15 companies in the S&P 500 and just think while I read these, how long could I go living a daily normal life without consuming a product from one of these companies? What would my life look like without, if I just said, I don't want any of those in my life. NVIDIA, they make computer chips for everything.
Yep.
But most people don't transact directly with NVIDIA, so I can appreciate that one. Microsoft.
That one's huge.
Apple.
Huge.
Amazon.
Huge.
Meta Platforms.
Huge.
Broadcom, which is a chip maker. Google, Tesla, Berkshire Hathaway, insurance companies, they own a lot of those. Yeah. I mean, there's a lot of subsidiaries that Berkshire has. Walmart, JP Morgan Chase, Eli Lilly, Visa, MasterCard, ExxonMobil, Johnson & Johnson, Costco, Home Depot, Bank of America, right? General Electric, Chevron, Coca-Cola.
Yeah. These are all companies that we're familiar with and that we see on a regular basis, interact with, so that you kind of get that tangible.
And it doesn't mean that company is just immune from everything.
Right.
And it doesn't mean that it's going to perform exceptionally well any particular quarter or year. What it means is by being diversified around the top, there's some degree of I don't want to say safety. It's really not safety, but tighter expectations maybe, right, about what's likely to happen. And I think the other thing to address, I mean, we're running out of time here, and I'm sure I'm boring the heck out of everyone, but the other thing that's really important is I keep coming back to this idea is so not only is it large, but I say be in the US, right? And I specifically am talking my audience. I'm kind of talking to people that live in the US. If you're international, I know we have some listeners international, this might not be as applicable. You really want to probably think more dynamically about how you hedge your currency risk. But at the end of the day, there is talk about the dollar is going to, we're here sitting here talking about debasement, right? And we're hey, the dollar's the best place. It's we want dollar assets. And what's unique about the world we live in this time is that there really is no alternative to the dollar. It's this theory, people say it's the cleanest dirty shirt in the laundry. Okay. Of all the currencies out there, all the foreign currencies, they're all fiat. So if you think the US dollar is getting debased, they're all getting debased. And so, I don't love the US dollar for a lot of reasons, but at the end of the day, it is going to suck up the liquidity of a lot of the other currencies. Through a number of means. And that's, again, not perfect every single, day, week, quarter, month. But over time, it's very hard to compete against a dollar, to the point that a lot of other countries have debt they issued that's denominated in dollars. So they have to get dollars in order to pay back their own debts, right? Like, so we sit here and price our lives in dollars and we think it's just normal. It's a great privilege, actually. Whereas like there might be somebody in, France that borrowed money from somebody in Japan, and that contract between them two is priced in US dollars. And so they have to circulate dollars through the whole system. On top of that, if you look at large cap US companies, the world has become so globalized and that I believe it's somewhere in the neighborhood between 40 and 50% of all the revenues in the S&P 500 companies is coming from international business. So you're capturing that globalization effect in large cap US companies, except you're keeping your asset in dollar terms. And for us that live in the US, it's sort of important because that's the world in which we live and pay for all of our stuff here locally.
Yeah. So just an example on that I was reading earlier today is Coca-Cola earns about 70% of its revenue from overseas.
Yeah.
So like that's a perfect
Let
example
them
of
take
that.
care of the currency hedging. Let them take care of converting all that, right? What you start dealing with when you invest internationally is you have two things you have to get right? And what's happened the last 10, 15 years that people just like couldn't really figure out and explain why all of a sudden like international hasn't been performing for them until this year is because you have to get the fundamentals right in the foreign investment, right? So you have to go to, SAP in Germany and say, okay, good business, good management, good cash flows, good whatever, right?
Yeah.
Like good profitable business. But then when that flows through, it has to also outpace like any change in
the US
the euro US dollar cross. And so if the dollar is getting stronger relative to euro, like your selection of company could be right and your thesis could be right and it's a good investment that way. And so for somebody that lives in Germany and just like lives their life in euros, like great investment maybe. Like they're like, hey, this is good. And then, but the exchange rate completely wipes out your return.
Yep. So when you go back to
and
the dollars,
so you have to get both right. And so what's interesting is like historically, if you look at some of the sovereign wealth funds from the Nordic countries, I'll just say, like they would buy S&P 500 unhedged in the US dollar, right? And it's because like, well, when S&P 500 would go down, there's this negative correlation with the dollar index. And so what would happen is they had a built-in hedge. Okay. And so their losses were never really, and their volatility was relatively low. Now this year it played against them. So this year when international and US investors are looking at it going, man, I wish I was international this year. Well, it's because the year that the dollar index went from 113 down to like 95, right? There's a huge drop in the dollar value relative to other currencies. I think that's actually bottomed out, and in a number of our models, we've been long dollar the last several weeks because of that, which is a nuanced thing. But there's an important thing to remember on the cross currency. If your thesis is, hey, the dollar, like, but why are we wanting stuff priced in dollars if we like think dollars is getting inflated? Yeah. We want assets priced in dollars. We don't really want dollars, right? So when you own equity stock, right? When you own large cap US stock and you check your like Charles Schwab account or your Robinhood or wherever the heck you invest at, and you see it says, $938,000. Like that just means how many dollars you get in trading your stock for dollars today. Yeah. That's it. You don't own the dollars, right? It's just giving you a quote on how much you could sell all your assets for. So one of the currency hedges that I do think is favorable is like, if I think the dollar is kind of the best of the fiat currency, I don't want to go and hedge and say like, well, I'm going to start getting all my investments in, like Zimbabwe, right? But there's this idea like, well, what about gold, And I think that's where I want to leave it. And we're going to pick it up in another episode around gold. And I think we're going to dive more into the currency conversation in that episode. And like, okay, where does that come in as a hedge then on the currency? But it still remains the same. You want gold priced in dollars, but you don't want dollars. You want the gold, right? Yes. So we'll wrap it up there. Yeah. And obviously always invite people to ask questions, reach out, let us know what you got going on. We're happy to chat, answer questions, cover any topic on the podcast here. You can find us at dusharmwealth.com, Facebook, Instagram, the Tall Oaks podcast, obviously anywhere you get a podcast. We're on YouTube. If you want to hear my continued ramblings beyond the podcast, you can find me on X personally. But anyway, any final thoughts, Carissa?
No, I guess, yes. I just think that it's important to remember that it's not just one of these elements that we're talking about is going to be used like individually, right? Like we're looking at using all of these different hedges against debasement together, like in conjunction with a full portfolio. So even though we're talking about how U.S. large cap stocks are important and they can be a good hedge against that debasement, it's not like everything you should have. You shouldn't just all of a sudden go and put everything you have in large U.S. stocks. Yeah,
if your entire like investment portfolio, your net worth is like large cap U.S. stocks, like buckle the freak up.
Buckle up.
Because there's going to be some really uncomfortable times ahead.
Yeah.
And you're going to want, I really, truly believe you're going to want some diversification across asset
There's
classes.
always a trade-off in that risk. So, I mean, I know we've talked about that before, and I'm sure we'll get into that again, but I just wanted to throw that out there that this is not saying like you want to protect yourself against debasement, go put everything in U.S. large cap stocks.
Yeah.
That's not what we're saying. So
yeah, it's just it's a part of a bigger plan.
Yep, exactly.
Anyways, thanks for the call out. We'll wrap this up and we'll see everyone out there.